Day trading is where you buy and sell stocks within the same day on the basis of short-term price movement. An example would be a trader buys 1,000 shares of a stock at 9:30 a.m. with the anticipation the stock price is going to rise. And then 10 minutes later, the stock rises 20 cents and the trader decides to sell the entire position. When they sell for a 20-cent profit using 1,000 shares, they just made $200. And they did it all within that 10-minute time span. Now, they can choose to do this as many times as they want during one day, given two things. The market provides them with the opportunities that fit along with the trader's strategy, and that they pass the PDT rule regulation. PDT stands for Pattern Day Trader, and the governing bodies that make up the rules and regulations for United States residents to trade the stock market say that anyone who has a total account balance of less than $25,000 using a margin account to trade is only able to make 3-day trades in a 5-rolling business day period. Now, remember what a day trade is. It's where you buy shares of a stock and then you turn around and sell those same shares that very same day. Now, since this is the same day, that includes extended market hours. So pre-market and post-market count within this PDT regulation, right? So again, as an example, let's say that we buy shares of Apple and then turn around 10 minutes later and sell those same shares. Then that would count as one day trade. And you're only able to do that 3 times within a 5-rolling day business period. If you go over this 3-day trade limit, you will be restricted from day trading for 90 days inside that account. All right? But if your account is over $25,000, then you can make as many day trades as you want. Now, unlimited day trade sounds amazing, but stock trading can be very emotional. And when you have the freedom to make unlimited day trades, it's very easy to start spiraling out of control, which is why I don't recommend beginners to have the freedom to make unlimited trades, because the emotional discipline isn't going to be quite developed yet. It takes practice, it takes experience to develop that emotional discipline. And as a beginner, you're going to make a lot of mistakes. You're going to lose money. And it's very easy to spiral out of control trying to take trade after trade, trying to make back losses or get back money off of a stupid mistake you did. I think being PDT restricted is great for beginners because it's going to teach you the most important part of trading, and that's discipline and patience. But once you get more experience and you start to develop consistency in your strategy and you developed a disciplined mentality to stay persistent in your strategy, you can use a broker that will allow you to bypass the PDT rule, and you can make unlimited day trades even if you don't have the $25,000. And these brokers are able to do that because they are located outside the United States. And when a broker is located outside the U.S., they don't have to abide by certain U.S. laws and regulations such as the PDT rule. So you just need to be aware that you will be wiring money outside the United States. You will have a broker account that's located outside the United States, and you'll be trading through them. So if that's something that you feel like you need to do in order to grow your small account and then get up to the $25,000, that is a possibility, but I would only recommend doing that once you have full confidence in your strategy, you are showing results inside a simulator, or maybe you are profiting well under the PDT rule, and you think you've developed the disciplined mindset to have the freedom to make unlimited day trades, then you can go that route. All right, so that is the PDT rule. I want to thank you so much for watching.